If you launch a rocket worth $100 million into space, and it explodes into a ball of blinding fire, your company might actually make more money than if it landed perfectly. It sounds completely insane. In any normal business, watching your primary product disintegrate on live television means immediate bankruptcy. The board fires the CEO, the stock price collapses to zero, and the regulators lock the doors. But the space industry does not operate in a normal economy. It operates in a parallel financial universe, where failures are subsidized, liabilities are vaporized, and losing money is often the fastest way to become worth billions. Most people look at a rocket launch and see an inspiring engineering marvel, a testament to human ambition pushing into the stars. But if you look closely at the glowing smoke trailing across the sky, you aren't looking at engineering. You are looking at a highly complex, deeply hidden system of financial engineering. By the time this investigation ends, you will see exactly how this invisible machinery works behind the scenes. You will understand where the money actually comes from, why businesses with zero profit are valued higher than legacy industrial giants, and the terrifying economic reality that most people completely misunderstand. Because if you follow the smoke trail back down to the concrete launch pad, you realize the roaring rocket isn't the actual product. It is just a loss leader. The visible business, the one displayed on glittering corporate live streams, is remarkably simple. A customer wants to send a satellite into orbit. They pay a space company a massive fee, say $60 million. The company buys raw materials, welds giant metal tanks together, fills them with thousands of gallons of liquid oxygen, and fires it into the upper atmosphere. The public assumes the math is just like shipping a package through FedEx. You charge more for the delivery than it costs you to buy the fuel and build the box. If you do that enough times, you make a profit, but that is the illusion. In reality, if a space company relies solely on that visible transaction, they are dead before the engines even ignite. The upfront capital required to build a single operational launch pad, secure regulatory clearance, and hire elite aerospace engineers is so astronomical that charging commercial shipping rates for payloads will never cover the historic debt. The margins on the metal itself are brutally thin. So, how do they survive? To understand the survival mechanism, you have to look underneath the visible business, into the world of creative risk shifting. When a traditional cargo ship sinks in the middle of the ocean, the financial fallout is devastating. But in the space sector, risk is the primary commodity being bought and sold. Long before a rocket ever moves an inch toward the pad, a silent ledger of insurance premiums, government-backed indemnification clauses, and advance milestone payments has already shifted the financial burden away from the operator. If the rocket blows up, the space company doesn't absorb the loss. The loss has already been fractionalized, packaged, and sold to global reinsurance syndicates. The company keeps the non-refundable launch fee, collects an insurance payout, and uses the failure data to justify more capital from investors. Yet, insurance syndicates don't have infinite patience. They won't fund a recurring fireworks show forever. To achieve true financial sustainability, a space company must tap into a far more lucrative, permanent ledger. And that ledger belongs to Uncle Sam. The single biggest misunderstanding about modern private space companies is that they are purely private. They are not. They are deeply integrated extensions of the state. Consider the historical shift in how governments buy rockets. In the old days, agencies used cost-plus contracts. A legacy defense contractor would build a rocket, tell the government how much it cost, and the government would pay that cost, plus a guaranteed percentage of profit. It was a license to print money, completely removing any incentive to innovate or lower expenses. Today, the system uses fixed-price contracts. The government offers a set amount, say $1 billion, to achieve a specific goal like delivering cargo to a space station. If the company spends $2 billion to do it, they take the loss. If they spend $200 million, they keep the massive surplus. This looks like free market capitalism, but it is a sovereign pipeline. The government becomes the anchor tenant. They lock in multi-year, multi-billion-dollar commitments before the rocket design is even finalized. This sovereign backing acts as the ultimate validation. The moment a space company secures a government contract, Wall Street views them as completely de-risked. Why? Because the state cannot afford to let its primary launch providers fail. If a critical space company goes under, the nation loses its sovereign access to orbit. Its ability to launch spy satellites, its national security dominance. But this government funding comes with a heavy, invisible cost. When you take the king's coin, your operational flexibility is severely constricted. You are bound by intense regulatory oversight, strict geopolitical restrictions, and lengthy defense audits. You cannot easily pivot your business model when your primary customer is a slow-moving bureaucracy. Which creates a massive problem, because carrying government cargo is a finite market. To scale to a valuation of hundreds of billions, these companies need a business model that doesn't rely on waiting for the state to order another launch. To break free from the constraints of low-volume government contracts, a space company must achieve something that seems almost mathematically impossible in heavy industry: true economies of scale. In a standard manufacturing business like building cars, your costs scale linearly. To build twice as many cars, you need twice as many factories, twice as much steel, and twice as many workers. But a space company scales by fundamentally altering the marginal cost of its infrastructure. Think of it through a simple analogy. Imagine if every time you flew a commercial airliner from New York to London, the airline threw the entire Boeing 777 into the Atlantic Ocean upon arrival, and had to build a brand new airplane from scratch for the flight back. The price of a single ticket would be millions of dollars. Only kings and billionaires could afford to fly. This is exactly how the space industry operated for 60 years. They threw the airplane away every single time. The breakthrough of the modern space company isn't just making the rocket land sideways on a drone ship. The true breakthrough is the financial compression of marginal cost. If you can reuse the first stage of a rocket 10, 20, or 30 times, the fixed cost of manufacturing that giant piece of machinery is divided by 30. Suddenly, your operational cost per launch drops from $60 million to just the cost of fuel and basic refurbishments, which is less than $1 million. But you are still charging the market rate of $60 million to your commercial customers. The profit margin instantly transforms from an industrial-era trickle into a Silicon Valley-style geyser. This massive margin allows the company to aggressively underbid every legacy competitor on Earth, starving them of market share. Yet, lowering the cost of entry for others creates a terrifying operational paradox. The cheaper it becomes to access orbit, the more crowded the sky becomes. And as the sky fills up with thousands of competing payloads, the value of simply moving things from point A to point B begins to erode. Transportation inevitably becomes a commodity. When a business becomes a commodity, the margins eventually compress back to zero. If anyone can buy a cheap rocket and launch a payload, then rocket launches lose their strategic value. So, how does an elite space company protect its valuation? They create an inescapable ecosystem with massive switching costs. They stop acting as a transport service and start acting as a closed platform. Instead of just launching satellites for other companies like telecommunications giants or Earth imaging startups, the space company begins launching its own massive proprietary constellations. They fill low Earth orbit with thousands of interconnected nodes, forming a global web of proprietary infrastructure. Think of it like an exclusive toll road. If a competitor wants to offer global satellite internet or real-time climate tracking or high-frequency financial data routing, they have to pay the space company to launch their hardware. But the space company already has its own hardware up there operating at a fraction of the cost. This creates an intense competitive moat. If a customer integrates their data systems into the space company's orbital network, leaving that network becomes an operational nightmare. The switching costs are too high. Legacy aerospace firms look at this and try to compete by building their own rockets. But they are completely trapped in the old paradigm. They are trying to build an elevator, while the modern space company is buying the entire building that the elevator connects to. But this strategy requires an unbelievable amount of upfront cash. Launching thousands of your own satellites means you are spending billions of dollars of your own money without immediate commercial revenue. To fund this capital-intensive expansion, the company relies on a hidden profit engine that has absolutely nothing to do with outer space. The true financial engine fueling modern space dominance is located entirely on the ground. Inside the psychological dynamics of private capital markets, a traditional public company is judged by its quarterly earnings. If profits drop by 5%, the stock gets hammered, shareholders revolt, and the executive team is under siege. This makes it impossible for them to invest heavily in long-term, high-risk infrastructure. An elite space company, however, deliberately remains private for as long as possible, or structures its public offerings to maintain absolute control. They don't sell current profits, they sell the scarcity of the future. Venture capitalists, sovereign wealth funds, and massive institutional investors are constantly terrified of missing out on the next paradigm shift. A space company leverages this anxiety beautifully. They raise capital at skyrocketing valuations based not on their price-to-earnings ratio, but on the concept of total addressable market expansion. Every successful launch is used as a psychological marketing event. It is a live-streamed demonstration of capability that signals to the market, we are the only ones who can build the future infrastructure of humanity. This constant narrative loop allows them to raise billions of dollars at nominal interest rates or high valuations, effectively using other people's money to build their permanent monopolies. The capital inflows are so massive that they can outspend any traditional competitor's research and development budget by a factor of 10. But this reliance on private capital and visionary narratives creates a fragile economic tightrope. If the narrative cracks, if a major regulatory body shifts its stance or a catastrophic failure halts launches for a year, the burn rate becomes a lethal weapon. The very same capital intensity that created the monopoly can turn inward, devouring the company from the inside out. To truly comprehend the vulnerability of this business model, you have to look past the spectacular launch footage and examine the brutal, unforgiving nature of its cost structure. A space company is an absolute furnace for cash. The visible costs, the raw steel, the propellants, the launch pads, are actually the easiest part to manage. The real financial danger lies in the fixed, non-reducible operational overhead. You aren't just paying for fuel. You are paying for thousands of highly specialized aerospace, software, and materials engineers. Individuals whose salaries are in the top percentiles globally. If your rocket sits on the pad for 3 months due to a bad valve or a regulatory delay, that engineering payroll does not stop. The burn rate remains exactly the same, bleeding millions of dollars every single week. Furthermore, the physical infrastructure is incredibly fragile. A single launchpad anomaly can destroy custom-built ground support systems that take years to manufacture and calibrate. The maintenance costs of cleaning, testing, and recertifying reusable components are highly unpredictable. Then there is the regulatory and geopolitical risk. Space hardware is legally classified as advanced weaponry under international trafficking regulations. This means a space company cannot easily outsource its manufacturing to low-cost countries to save money. Every single bolt must be tracked, every worker must clear stringent security clearances, and every international launch sale requires state approval. They are operating a high-volume manufacturing business within the legal framework of a nuclear missile program. This creates a structural floor beneath which costs cannot drop. If global capital markets freeze up, or if an economic recession causes private investors to retreat to safer assets, a space company cannot simply downsize its way to safety. It must keep launching, or it will suffocate under its own weight. Despite these terrifying risks, why do investors continue to pour hundreds of billions of dollars into this void? Why does the industry continue to scale at an exponential rate? Because the ultimate destination of this economic journey isn't about transportation or satellites or even national defense. The true endgame is the control of data and resource distribution on a planetary scale. We are currently transitioning from a terrestrial economy based on physical land and local infrastructure to an orbital economy where the most valuable assets sit 300 miles above our heads. The company that owns the dominant space architecture will effectively control the routing of global information. They will provide the synchronization clocks for global banking systems. the real-time mapping data for autonomous transit, the low-latency communications networks for sovereign entities, and eventually the logistics pipeline for off-world manufacturing and resource extraction. When you look at a space company today, you shouldn't compare it to Boeing or Lockheed or FedEx. You should compare it to the early Standard Oil monopolies or the transcontinental railroad systems of the 19th century. The rocket is simply the iron rail. The company that controls the rails controls what flows over them, who gets access, and what prices they must pay to survive. This completely changes the perspective of the entire business. The public believes the economics of a space company depend on the difficulty of escaping Earth's gravity, on the physics of thrust and weight, but it doesn't. The true economics depend on the physics of capital concentration. The rockets are built to escape gravity, but the financial system behind them is designed to create a gravitational pull so immense that no other competitor, customer, or government can ever escape its orbit.